All right, great. Hey, everybody. Welcome to this webinar to talk about Bryn Mawr Village Apartments. We've got the ABG multifamily team here. Let them introduce ourselves real quickly. Michael, you want to go first?
Yep, I'm Michael Crocifolia. I've got about 6 years of multifamily investing experience. I've got my own portfolio of about 30 units up in the Northeast, and I've been involved in syndication for about the past year.
Great. And this is Bethany.
Yes, hey, I'm Bethany Roberts. I have experience in residential real estate and now multifamily under Ashley and Michael's teaching, and I've learned a lot, and it's been very exciting.
And I'm Ashley Garner, and I've done a lot of real estate in my life. Always have dreamed about doing larger scale multifamily, ramping up the number of units. And so it's great to have Bethany and Michael on the team as we go into this syndication deal of a 196 unit property in Jacksonville, which is Bryn Mawr Village. And that's what we're here to talk about today. Before we get started, maybe we'll talk a little bit about why we like investing in real estate and what that can do for you. So Josh, if you want to hit that slide, we'll show everybody just a few quick things, and then we'll get into the investment itself. So the things that we like about real estate investing, one, it's passive income. So it's not an investment that you just make and hope to get something back from it in the future. These types of investments are cash flow investments. So and this one in particular, for example, we're projecting quarterly payouts. So you don't have to wait until the end, until we sell it or liquidate it. You're actually getting paid the whole time. So that's pretty important. In addition, you do have the appreciation, meaning that real estate tends to grow in value over the time that you own it. So when we do sell it, the idea is that it's worth more than it is when you buy it. That's appreciation. One of the things that's really particular to real estate are the tax benefits. Many other investments do not have the tax benefits that real estate does. Mainly, this comes in the form of depreciation. So the idea there is that you've got these buildings and structures and light fixtures, et cetera, and they all wear out, right? So the IRS lets you have depreciation, meaning they're worth less as you go, and you can use this against your income and thus pay less taxes while you're depreciating the asset. That's pretty huge. And diversification, many of you are invested in things such as stocks and bonds and whatever else. Real estate is a good way to diversify some of your portfolio into a different asset class. So those are some of the things we like.
Yeah, and Ashley, I know you've done a bunch of deals. I've done quite a few myself, and it feels, people always say real estate is all passive. There's different levels to the passive versus active. So when we're managing it, sometimes it feels a lot more active than passive, right?
Oh yeah.
So this is a true passive opportunity where you're setting your money and you're forgetting it. You
That's
put
right.
it into the deal and it works for you.
That's right.
So there's a different levels to the game.
And it depends on which side of the table you're sitting on. So the three of us, you might call the general partners, right? And or the syndicators or the promoters. You hear these words around these investments. So we are the GP or the general partner. For us, this is very active. We work a lot at what we do. So I do have investments that I've had for a while, and they kind of get a little more on autopilot. And in that regard, it's pretty passive. In this one, especially now in the acquisition phase, it's very active for us. We're busy a lot. But for the limited partners, like Michael said, you just put your money in. We send you reports and money, theoretically money every quarter, and that's your involvement. Let's see what we've got on the next one there, Josh, as we go through.
Okay, so before we get into the specifics of Bryn Mawr Village, I think it makes sense to just give you an idea of what type of metrics we're looking at every day and what are appropriate metrics to be looking at if you were to engage in a real estate investment like Bryn Mawr Village. So the first one is just your cash on cash return. It's a pretty simple metric. and it's designed to measure the profitability of a real estate investment. So it's calculated by taking your annual cash flow, and that's divided by the cash you have invested. So if you take your $100,000 investment, $50,000 investment, whatever it ends up being, and we're giving you $7,000 a year, you would take that $7,000 of annual cash flow, divide it by that 100,000 that you have invested, and you come up with a percentage. A percentage typically is going to be something that you could compare to the returns that you get in the stock market, right? So a 7% cash on cash return, 8%, 9%. It all depends on what the scale of the deal we're able to deliver.
Right. And Michael, right now, so most people would understand like a savings account, right?
Mm-hmm.
Savings account, you get whatever percent interest. And the best I can find right now anywhere is about 5%. So you say, all right, well, I know that I can put my money in the bank or in some other pretty reliable safe place like a savings account and get 5%. So maybe I take some of that, diversify my portfolio, put some of that cash into real estate, which should pay more than the savings account. In this case, it pays a lot more than in the savings account. That's just one of the reasons somebody might want to do something like this.
Yeah, and things get even more exciting when then you look at the average annual return, right? So
There
the
you
average
go.
annual return is
Then
going
you
to
get bigger numbers.
right. So it's gonna take a look at your total cash flow over the lifetime of the investment. So that annual cash flow times the number of years you got in the deal, plus your capital gains. So that's going to be when we refinance or divest the asset at the end of the 5-year period. You're taking the aggregate over the 5-year investment, and you're dividing that over the cash you have invested. So
I take all the money that I make over the 5 years and divide it by 5 years, and that's your average annual return.
divide it by the cash you invested and then divide it by your years, and you get the average annual return, which is going to be a percentage of what you invested over a given year period.
Good.
The final metric we have here, and then we're going to stop boring you with some formulas. It's the internal rate of return. So this one we are not even going to attempt to explain, because it's basically calculating the net present value of your money over a 5-year period. But what it's meant to do is take the inflationary risk out of the situation and give you more of a clear picture over time of what your money is going to be worth.
Right. And so really all of these things, once you pick your favorite metric, and you may pick more than one, but they give you a way to compare investments. And you'll begin to see pretty quickly, like, oh, now I see that this type of investment, the IRR is high teens or low 20s, and I like that. And if I see one that's maybe less than that, maybe I don't like that as much. So you just educate yourself as an investor using these tools to decide which one you want to be a part of. So I think now we'll jump right into the Bryn Mawr slides, if you don't mind, Josh.
I think we have a couple examples of those calculations on the Bryn Mawr deal. Or do you want to jump right in?
Yeah, let's just jump right in. I see the people that are with us right now, and I know all of these folks understand this math pretty good. Yeah, so my first thought here is as I see the disclaimer page, right? And it brings up a time to talk about the structure of this deal. So the general partnership owns 20% of the entire thing. The limited partners, which we'll call the Class A owners, will own 80% of this deal. Okay. So there are ways that the SEC, they kind of govern this. It's called a security. Just like if you bought Apple stock, for instance. There are some rule exemptions that we use so that we don't have to go ahead and file a full IPO, for example, which takes a long, long time to do. And we're using the rule exemption 506C, which means that all investors have to be accredited as defined by the IRS. And then we go through, and then there are some fees that we take, and our SEC attorneys want to make sure that we disclose all of the fees and all of the involvement. These fees are customary to syndication type deals, And, but they're right here on page 2 of, I think that's page 2. Yeah. Of the package, acquisition fee and asset management fee and the capital, transaction fee. So those fees are taken out as expenses, and then everything else is just split on a prorated basis. So the limited partners will get 80% of everything after expenses, and the general partnership gets 20%. That's the basics there. Michael, you want to go through that deal at a glance?
Yeah, for sure. So, uh, for our accredited investors, minimum investment at this time is going to be $50,000. Accredited investors, I think the people on the call probably know what this means, but to briefly go over it, it means you have a net worth of $1 million outside of your primary residence, or you've made as an individual $200,000 per year in the last two tax returns, or as a married couple, $300,000 combined. Total equity that we're raising for the deal is $8 million. The average annual return that we're projecting is between 20 and 24%. So these are the metrics we were just sharing, cash on cash, varying between 8.5 and 9.25%, IRR between 20 and 23%, which is really strong. The duration, so we're estimating a 5-year hold, and we would distribute quarterly. So one of the great parts about this deal is some real estate deals, they're ground up construction. They might be a value add play where you're taking 12 to 18, maybe even 24 months to reposition an asset before you're issuing distributions. The beauty of Bryn Mawr Village is it's already functioning. It's already working really well. So those quarterly distributions should come sooner rather than later.
Yeah. And so I think it's important to hit on these 3 return metrics one more time: average annual return, average cash on cash, and IRR, because the ones that we're offering in this deal are really good.
Mm-hmm.
I mean, let's just be honest. And so, as those of you who do this already, you look at this and you say, well, those are pretty good numbers. And then your next question is going to be, why do I think these 3 can pull this off? And, and that's important. That's what you should be asking. And so I think it's one thing I want to share with everybody is that the 3 of us, and especially me, are very conservative. That's not to say that y'all aren't, but sometimes they have to pull me out and say, Ash, it's okay. That it's not this risky. We can do this. Because my nature is just to be so careful that I don't mess anything up for my own financial position and my family's financial position, but especially because investors in these deals with me so far have almost all been people that I know and see every day. Some of them are family, most of them are friends. And the last thing I want to do is lose somebody's money. So I tend to be very conservative, meaning that when we do our pro formas and our anticipation projection of how the finances are going to look over this 5-year period, we don't push the limit. We don't say that we're going to have to raise rents by 5, 6, 7%. We're very conservative with that. Expenses, if anything, we overestimate expenses, and we've done that in this deal, and the returns are still that good. So that's pretty exciting. I wanted to hit on that right away because as I see these returns, they're fabulous, and these are something that we really do expect to hit. It's not a dream that we have if everything goes right that we'll hit these numbers. Right out of the gate, we're going to hit these numbers. And the executive summary, we could probably pass through this. I think Michael kind of hit on that in the deal to glance, unless there's something that you want to hit on.
I think probably just real quick, it makes sense to talk about the business plan itself.
Yeah.
So the asset it's 196 unit multifamily investment property. It's got 32 storage units to go with it. And then it has a ton of amenities. It's got a dog park. It's got a pool. It's got things that the competition in the area don't have that support why you would rent from Bryn Mawr Village as opposed to the competition. The property functions as is. It's got 97% occupancy. But what we love about it is that we're not putting a huge CapEx budget into it. So we have $500,000 appropriated to invest in the property. properties of this size, sometimes you'll see CapEx budgets of $2-3 million, and that's to renovate. That's to put the granite countertops in, the new LVP flooring. And our properties already have various stages of renovation, and it's performing as is, that we don't feel we need to invest a huge amount of capital to get it where we need it to be.
Yeah, and a little commentary on that, the way we see it. Today's economy is kind of hard on people, and inflation is a real thing. The costs are going up just to survive. Now is not the time in our economy to be raising rents. Now is the time to be uh, keeping your turnover as low as possible. Um, it's not the time to be making large capital improvements in which you have to then raise the rent by a large amount just to make it worthwhile. That will come back. We've had that in the recent past. That's not what's happening right now. Was another reason that we're not doing a large capital improvement here. But the real reason is that we just don't have to, because the rents that we need to make this deal work financially are rents that we're already achieving. And so we don't need to make this big, heavy lift in order to get the performance that we need out of it.
Yep, we can keep on scrolling.
I'll just add on here while we're scrolling that
Thank you.
the community is really attractive. Like when you drive in, it has a really great neighborhood feel. It's a great place for folks to be. And I think it's an awesome place for when we visited. We had a great time over there. And the feel, it's beautiful. It looks great. So it's always great for folks in the area, you know, to know that the competition is nothing like this place.
It was hot that day, wasn't
It
it?
was so hot that day.
So tell them a little bit more about that. We took our whole team and our property manager, right? We went up there and toured around. Maybe
Yeah.
tell them a little bit about that.
Yeah, we checked out all the 196 units, checked everything, met the residents. It was fabulous to see the relationships that they had, you know, with the management in the past. So clearly well managed, and folks are, you know, open to meeting us. And I think we had some great conversations with those folks.
Yeah, that was a good day. We were happy to get back in the office for our little breaks because there was AC in the office and it was really hot. But the office is right by the swimming pool, which is a fabulous amenity. And then they had a nice gym inside the office complex, which was another nice amenity. And we asked the property manager, does it get used a lot? And she said, yes. In fact, that community used the workout facility more than almost any that she'd ever worked at, which was pretty cool. We think that there are ways to expand that inside the building. We noticed some underused spaces inside there that we can repurpose and add some more exercise equipment. That would be cool. Michael, you mentioned the storage units, 32, right? And those were underutilized as well. Some of those were used for supplies and materials, the tools that the property management used. So those units were designed to be rented out to tenants. And that's another way that we think we can increase the income. And again, that's not a big capital improvement. That's just storing your shovels and brooms in a different spot so you can rent out the units. So that was pretty neat. Low hanging fruit, if you will.
So I know this projected pro forma is a bit of an eyesore to look at online,
tough,
but do we want to talk about the rent assumptions and why we think it's
we
going to
should.
be achievable?
Yep.
Okay, so in terms of our plan, we believe that there's a opportunity because the property is lagging behind the basic allowance of housing in the area for Camp Lejeune. So the average rent right now is $1,140 per unit. We have an estimate that this will be achievably raised to $1,350 within 3 years. The reason we think that is because the basic allowance for housing right now at Camp Lejeune for an enlisted person with dependents is $1,389. What can they use that $1,389 on? It's rent, it's a mortgage if they have a home, and it's utilities. That's it. They can't buy groceries, they're not buying clothes, etc. So this is what it's appropriated for
Right now.
Right now.
Yes.
And so it's already at 1389. The past 5 years, it's grown 21%. So if we look at what it was back in 2019, it was already at what our average rent is now. So if we take that 5 years from now and we say, okay, if we follow a similar trend, even if we cushion it and say it's going to grow 15% in the next 5 years, which is very reasonable,
Right.
that puts it at close to $1,600 now per month for the BAH. And we're saying we need our average rent to sit at around $1,350 to deliver the results that we're sharing in this deck.
Right. And another exciting thing regarding the rents is they are already achieving in the most recent rents, they're already renting at the level that we need them to be at like month 30.
Yep.
Right.
Yep.
So already the market is giving us the rents that we need, that we have expected to get, 2.5 years from now. And the true average of those rents at the 1140 or 1144, that includes some units that have not turned over in a long time, and their rents are very low. And we toured all 196 units, and we saw some of those units, and the people have lived there happily for a long, long time. But their rents were lower than the rents they're getting now, thus the average is what it is. So we're very optimistic that we can reach this is a very low bar to achieve in our pro forma. This slide is one of my favorites. And again, viewing it from this way on the webinar, it's tough to see and it's not interactive. I love spreadsheets. The only person that I know that likes them a little more than me is Michael. He's a lot better at them than I am, but that's because I started learning them back in the early 90s, and we were pretty basics. But so this slide in particular, it tells the limited partner investors what they could get in the way of returns, right? So Bethany, you talked to someone today, and what they were using a number of 100,000, right? So they were going to consider investing 100,000. So what we're going to do then is we're going to take this section of the spreadsheet, and we are going to put in 100,000 there. And once we do that, it'll kind of break out all of the other returns that investor can get. So each year they'll get cash flow payouts, and that's noted on there. And then at year 5, when we've projected to sell, they will get their share. Well, first they'll get their 100,000 back. Then they'll get their prorated share of the net proceeds on the sale. And so that's what this slide shows. And then it calculates the returns. So that's I spend a lot of time on this slide with potential limited partner investors. It's a good one.
And we actually just updated these figures probably about 4 days ago. And what you're looking at was what it was originally projected at. So they've got the old cash on cash, the old average annual return. So we'll share with everyone on the call what the new figures are so that it's up to date. But the cash on cash is well over 9% now based on what we're projecting. And that average annual return based on that deal at a glance that we looked at the beginning was sitting between 20 and 24%.
Yeah. So Josh, maybe go back to the previous slide if you don't mind. And so we've made some operational improvements, or actually we haven't done anything yet other than we've done a lot of investigating. We've done a lot of emailing, a lot of phone calling. But the improvements have come in 3 areas. Number 1, they've come in payroll. Number 2, they've come in insurance. And number 3, they've come in interest rate, mainly. Other ways, yes. But mainly in those 3 areas, we have seen places that we can improve the financial performance. And those are all kind of market-driven things. They take attention and they take investigation, which we've done. But we are benefiting a little bit from the market improving in those 3 areas. And again, this is very general for all of you who are watching on the webinar. Be happy to talk to you in much more detail about any or all of these things that you're hearing that might be of special interest to you.
Did you mention the debt position?
I think I mentioned it, but
Did
why
you?
don't you go ahead and
Yeah, just to give a little more color around what's going on in the financing market right now, it's really positive for a deal of our caliber because when we originally underwrote this, we were at a 5.91% interest rate,
and we're borrowing how much?
$15 million approximately.
Right.
So when you take a look at where the market's at today, if we were to lock the loan this second, we'd be at 5.26. So that's 65 basis points more
That's
or
a
less.
lot.
And what that means is maybe it doesn't sound like a lot on a mortgage, but when you take it aggregated across that size, we're talking close to $100,000 worth of cash flow per year that we get to designate back to the investor.
Right. And the first year is interest only.
Mhm.
So the first 12 months is interest only. And so you could do that math if you wanted to pretty quick and find that savings, but it's large on the savings. And then over the 5 years, like Michael said, it's almost $500,000,
Mhm.
and that's a market-driven thing. Our loan is based on the 5-year Treasury, 5-year U.S. Treasury, and we have a spread on top of that, which is the pricing that we pay the lender, and we have fixed that uh, back in was it early August, I think, right?
Mhm.
And since then, we've benefited because those treasuries have gone down a lot. And so we constantly keep our eye on that. So when we say make the numbers are fluid a little bit, that's because if we locked that in today, it's what it would be. It will change tomorrow.
Mhm.
It changes at all times. Right now, it's staying pretty low, and we're actually at the floor of our interest rate.
Yep.
So we're pretty pleased.
So Ashley, you're going to make us all this money. Now, how do you protect it? How do we not pay the tax man?
Uh, yeah, well, so one of the most fabulous things about real estate is that depreciation, right? And so in residential, commercial real estate, you can, the straight line depreciation will be 27 and a half years. So if we didn't do anything special, you just take whatever the buildings are worth and you divide it by 27 and a half years, and you deduct that from your taxable income each time, each year. But we're not going to do that because we're leaving a lot of money on the table if we do that. So we will hire a firm to do a cost segregation study right away as soon as we close. And they will come in and literally count every light fixture and every toilet and the square footage of shingles and the square footage of asphalt. And they generate this huge report, very detailed, that we then, it allows us to break each of those properties into their shorter lifespan. For instance, like I don't even know one.
Appliances.
Appliances
Yeah.
may have a 5-year lifespan,
Right.
right? Okay, that's a good one because that's a pretty short one. But each component of the building has its own lifespan, which is shorter most of the time than 27 and a half years. Then we use bonus depreciation on top of that, and we'll pull 60% of that in the first year to use as depreciation. End result is that we expect in this situation that probably at least 3, maybe as many as 5 years of these cash flows could come to limited partner investors, and they pay no tax on.
Yeah, and the reason for that variation is it's really case by case and how many investment properties you have on your Schedule E. So if you have several investments, you can actually utilize the depreciation from our deal in your other scheduled investments. So it doesn't have to be limited. It's anything that you are passively invested in.
That's
So
right.
it could be, if somebody has several other properties, you're probably leaning more towards the 3 years. If you have this as your sole investment, you're probably looking at an entire stretch on this tax free.
Yeah, and I'll mention this because I see some people on the webinar who are real estate professionals like we are. Um, and here's something pretty cool. For those of you who aren't real estate professionals, this probably won't apply to you. But I guess you could try to get your real estate license. But anyway, no, if you are a real estate professional, then the IRS will put all of this into the same bucket, right? So if you sell a house and make a real estate commission, that's in this bucket. And in this case, if you're a real estate professional, your investment income from real estate investments would go in the same bucket, which means that the loss you could get from investing in this property could also offset the income that you get from making the commission on the house, right? So that's pretty cool. That really reduces your taxable income. For those of you who aren't real estate professionals, then you would use this passive loss either to offset passive income from other investments you already have or from the income that you would actually receive from this particular investment. Either way, it is an amazing tool, and it's only with real estate investing. Yeah, so this slide, it goes into detail about what we plan to use, how much money we plan to raise, and then what we're going to do with this money. So it goes through the CapEx budget, closing costs, loan amount, et cetera, like that. We're saying $8 million. Our number that we're trying to raise is actually slightly less than 8 million, but we like to keep it simple and round up and say 8 million. Yeah. So, Bethany, this slide is it's kind of just telling about the property. You want to give a little brief kind of overview of what it's like there?
Yeah, absolutely. When you're driving in, off the main road in Jacksonville, I was surprised at just how like pretty it was. We drove in and it really does feel like a neighborhood. It's got its own, streets going through. It feels really homey. You can tell people feel like at home and safe there. They're about, just doing their business, walking around, chatting with each other. The pool looked great.
It did.
It looked
especially
really
that
good.
day.
Yeah, especially that day. Yeah, the pool looked fabulous. The dog park is great. People were having fun with their dogs. It was just a very like happy, enjoyable community to live in, it looked like.
I agree. And I had an experience on this particular property. I was able to drive my wife and daughter. They were with me, and we got to drive through this around the property. And I like doing that because I value their opinions a lot. Sometimes I get like tunnel vision and I see what I see, and they see things very differently. So when we drove through, their reaction was was pretty much the same that you described, and that wow, this place is really nice, and I feel comfortable here, and it feels like a home, and that's important to us. You know, one of the experiences that we had during COVID when the world got crazy, the financial world, things that didn't suffer were real estate investments because people value where they live. And one of the ways that we plan to add value to this particular asset, and we've had success with this in the past, is to really fine tune that pride of ownership type thing. And so things such as, sealing and striping the parking lot, it's not a difficult thing to do, but it just makes the place look so nice. Maybe we can work in some uplighting on, there were so many beautiful trees, right?
Mhm.
It really felt very park-like there. And so we can accentuate things like that. That's a way to add value because that reduces turnover. Turnover is one of the most expensive things you can have. It reduces vacancies, and vacancies are a killer. And it also allows you to increase your rents just organically because it's just a nicer place to live. So I'm glad you brought that up about feeling homey because it really does feel like home there.
Yeah, in terms of like the building, how many buildings there are, the structure. So you've got 31 buildings on site. It's 100 townhomes, 96 garden style apartments. So you've got 31 roofs, obviously, to maintain. One of the great things about the capex on this project is 28 of the 31 roofs have been replaced in the last 10 years. So what that means is over the course of our ownership, we should really have less than 5 roofs that we need to appropriate funds for to fix over time, which is great.
Yeah, that's great.
And I don't know if you guys could see it, but I'm sitting closest to the computer, and we saw actually some investment docs get signed while we were on the call here.
Oh, great.
Pretty exciting.
Congratulations. Yeah. Yeah. Yeah, that's fun.
Yeah.
Did they invest $8 million?
We're gonna check
If
out.
so, we can just end the webinar right now. Hi.
So here we got some more photos. We scroll.
By the way, so these photos on we have an investment portal, and the link to that, I don't know if we can get it up here on the webinar, but most of you can have either already have it or we can send it to you because we're making note of who's here. Or if any of you who are watching this recording of this, the link to the investment portal will take you inside behind the scenes and let you see all of these things. So there are lots and lots of pictures there that you can go and browse. There are all of the investment documents. So there are about 5 legal documents that you would have to sign in order to become an investor. And you can see all of the marketing materials. So this slide deck that we're looking at here, plus some other supplementary things, are inside the investor portal. It's a fabulous tool. Another one of my favorite things about it is you could once you set up your profile and you say how much money you'd like to invest. Then when it comes time after you've signed the documents to fund your investment, you set up your bank account and click the ACH right from inside the investor portal. The money then comes to the bank account. But then the really cool part is when it comes time for us to send money back to the investors, we just click a button on our end and the distributions go straight back into that same bank account. It's really, really a very user-friendly platform. I think you'll enjoy it.
And our accountant loves that as well.
Yeah. Yeah. It makes doing the K1s pretty easy on him. He does like that.
And if you ever need any help while you're setting things up, you can feel free to call any of us and we can walk you through it.
Yes, good point. We've had to do that, haven't we? By the way, for any of you who decide to do it, and maybe you'll create your profile, but then the next step is to fund your investment or things like that. You could expect a friendly phone call from Bethany, most likely, to as a follow-up, and it is a friendly phone call. She's wonderful at that. But yeah, we'll kind of monitor the situation as we go because we can see it all on our end and just help you out with reminders, stepping through it. Hey, back up there one more time, Josh. This last set of group pictures here is some of the amenities. Again, this stuff leads to the homey feel, right? There's already a dog park. There's already a playground. There are already grills and picnic tables. These are things that I've had to add at other properties to increase the homey feel and the amenity. This property already has them. And like Michael mentioned in the beginning, it sets this property apart from lots of the competition that does not have these things. So we're very pleased with that. Our opportunity here is just to tighten things up, tweak them a little bit, make them a little bit nicer, and then the tenants love where they live even more. This section is probably something that we can skip over a little bit. It's a lot of detail. And this is from the offering memorandum or what the brokers created for the seller to share with us. And so if you are into this kind of thing, take a look at page 14 and get you some good detail. The neighborhood, Bethany mentioned the neighborhood feel. It's also important to know that on a larger scale, this property is sandwiched by residential. So and I think that's important to note because it's not backed up to an industrial site or a gas station. It's buffered on all sides by residential, which really keeps that neighborhood feel going. That's important.
It was so quiet there too.
Yeah. It's a good spot.
And if you look at the tenant base, so right now I believe it's sitting at about 43% active military. And then if you include the personnel who are there that are non-active military, but supporting the base or supporting Camp Lejeune, it's probably closer to 60, 70%. Camp Lejeune is a driving force for a lot of the economy in the area. It's been open since 1941. It's going to stay open while we own the property for the next 5 years. And our property's been there since 1973 to support it. So we have a lot of security that we feel is a huge benefit to us buying this.
Absolutely. Good point. I agree. We talk more about these next few slides are going to talk more about the larger, broader area. Um, it looks to me like everybody on this call is from North Carolina, but there are a lot of you who are not going to be. Our target market at ABG Multifamily, by the way, is North Carolina. And why? Well, one reason is we know North Carolina, but the main reason is because investing is all about the numbers and what you're comfortable with. The main reason is North Carolina is one of the most desirable markets to invest in the whole country. And so investors from, Texas and Arizona and California, the Sun Belt that you might hear it called. So, Florida, South Carolina, North Carolina, Georgia, these are places that they want to put their money. We happen to be experts, the local experts in, North Carolina real estate. And so we've chosen to keep our focus on North Carolina markets. And now it's important also to know that we didn't do this just because we like North Carolina. We have, we've analyzed the numbers in all of these. So the employment growth, the population growth, the crime rates, in all of these towns that are our focus, and they all outperform most markets in other states, for sure. So as we go back through these slides and it tells about Jacksonville and the larger North Carolina area, these slides support why that is. But I think it's pretty widely known that North Carolina is growing, the net migration is positive, and the outlook is for that to continue. Well located, the property specifically is kind of right across the street, not literally, but it's very close to Camp Lejeune, to the base. So for those employees who work there, it's very convenient access to them. Again, more supporting information about Jacksonville. By the way, we another thing that we analyzed was the new supply of multifamily coming to Jacksonville. We did this because the last thing you want to do is invest money in an area in multifamily, and then next thing you know, thousands of units are coming on the market. And now there's your competition, and the market's diluted. Well, in Jacksonville, there is very little new construction of multifamily. We won't bore you with the details, although we have them if you'd like to see them. But the gist of it, what was it, Michael? The report was
So
one page.
Yeah, you've got one group that's building up there, and they have a culmination, maybe 4 or 5 properties they're scheduled to build over the next 3-5 years. If you take that compared to Wilmington, so it was a one pager, to your point, where there's not a whole lot going on in Jacksonville in terms of multifamily construction. If you look at Wilmington, for example, where we see apartment buildings going up everywhere, you've got 6 pages worth of detail to sift through to figure out if your investment's going to pan out while those get absorbed into the market. So in my opinion, I would fully rather invest in a market that's undersupplied than something that's going to be oversupplied for the next 3 to 5 years.
Absolutely. Yeah, good. What you got next there, Josh, on the way of slides? We're nearing the end of the book.
Wrapping up.
Yeah, good. Yeah, this slide tells a little bit about our team. I think that's important. So you've met the team of ABG Multifamily, and it's a wonderful, strong team. On both sides of me are individuals that are far smarter than I am. And, you read that in a book, right? You need to not be the smartest person in the room. And so I have checkbox. I have achieved that, and thank goodness. But back on the slide, you've got the vendors such as our attorney, Equitas Partners, actually happens to be a local attorney, didn't necessarily need to be, but our attorney, Sam Potter, is one of the most well-respected attorneys when it comes to this specific thing. In fact, when we get on the phone with attorneys for lenders and things like that, they all know Sam already. And so he is such a valuable resource through this process. We've worked with Sam before, and we're happy to be considered one of his clients. And then you've got Mortensen Accounting. So we have Doug Mortensen and his firm that are more of a CFO position for us than they are. They're not just our tax preparer. So we work very closely with them. They will be the firm that will distribute the K-1s to all of the limited partner investors at the end of the year. And they monitor all of the bookkeeping. They handle all of our internal corporate level bookkeeping. AM Realty, and the principal's name is Allison Regitz. They are the property manager for this deal. Their headquarter office is out of Charlotte. They also have offices in the Charleston, South Carolina area and the Fayetteville, North Carolina area. So the Fayetteville region will manage this property in Jacksonville, and they were there with us on site. Allison and two of her teammates were there and helped us tour all of the 196 units. Allison also manages another property that we already own in Gastonia. So we have a tight working relationship with her. We meet, and we did today, right? Via video. We meet every week with her on our properties, and we go through our spreadsheet of KPIs, what our vacancies, what our collections, all these things. And we hit those really important indicators every week with her via video. The one vendor that's not on here, by the way, is Premier Law Group, and that's Mauricio Raul. They are a firm out of California, and they handle the SEC law, and that's a whole thing. They're it's a very small niche that they handle, but when it comes to syndication, which is how this is structured, it is very, very important not to make any mistakes. So this is the second deal that we've used them on. Very pleased with their performance. So all of the documents that you see, like the operating agreement, the private placement memorandum, et cetera, those were all prepared by Premier Law Group. And that's pretty much our team.
Yeah, and I think to sign off, I'm gonna steal your favorite line about this deal, where it's not sexy, it's not flashy, but this is a safe place to put your money for the long run and a good way to make passive income.
Yep. What more could you want, right?
That's what we're all looking for.
Yeah, happy to open it up for questions. Yeah, if there are any, for sure. It's always more fun when it's a dialogue situation. We do have other people in the room with us, but they're busy doing other things like sound and video, so they're not interacting with us much. So.
And if there's no questions, if you think of anything, feel free to email, call, text. You have our phone numbers, you have our contact info, and we'll be happy to answer any questions you have.
Yeah, and I'll throw out two questions that I think were important. I know. Now these are questions that investors have asked us in person, right? So these are probably could be called FAQs, or frequently asked questions. But one of them is, how much money are you guys putting into the deal? Limited partners always want to know, like, does the general partner have any skin in the game, right? And I'll just tell you that I will have $250,000 invested into this deal personally. Michael and your group, how much you're gonna have in there?
Between myself and my family that we're incorporating, it's going to be a combined 470,000.
Yeah, there you go. Pretty good. So that's important. I think people want to know, well, are you just taking all my money and buying this and you don't have anything at risk? Quite the opposite. We've got a lot at risk, but more than anything, we see the value in this. Like, I'd rather have my 250,000 in this than anything else, or I wouldn't put it there. That's how good we think this deal is.
Could you imagine my Thanksgiving dinner if things didn't go well?
Yeah.
Yeah. So we vetted this thing pretty well.
Yeah. Yeah. All right. The other thing is, another question that's commonly asked is, who is the seller, or who's the current owner? Who's the seller and why are they selling it? Right. So tell them about that.
Yeah, so Monument Capital is the group that's divesting of the property, and they follow a similar model to what we do. They bought this 5 years ago. They bought it for about $14 million, and they're divesting now to pay back their investors over the 5 year hold period. So it's owned by Alex Rodriguez's group. That's their name, Monument Capital. But if it's good enough for a Shark Tank investor,
Yeah.
I think we're probably onto something quite good.
Yeah, exactly. And it's a normal business cycle, right? They're closing
Yeah.
out this fund, and so they're selling this property as a part of that fund after their 5 year hold. It's the same exact structure that we have here. They'll sell it. They'll offer the money back to their investors. The investors that want to roll it on and keep going will be a part of their next deal. So it's the same kind of structure. I'm sure there's more questions, but those are two that come up pretty often.
Mm.
How do you participate is a good question to answer. You can click that link that was put up in the chat. You can what's that? Yeah. Okay. I'm sorry. Yeah, we'll email that out to you. Again, most of you already have it, but if you don't, and most of you already know me, just call me or text me, and we'll make sure you get it. We would love to have you involved. Please tell anybody else about this. This is a 506C offering, which means that as long as you're an accredited investor, you can participate. So we would appreciate you sharing this deal with anybody you can think of.
And if you need any more confidence in Ashley, you know, he's been mentoring me fantastically, and I've learned a lot under him. And one of the first things he told me was, you need to treat the people that you work with and that you work for, your clients, your investors, like you would treat your own mother. And so if Ashley's treating you like his mom and we're all doing that, you're in good hands.
You're in good hands. That's right. Well, thank you. Very nice. Thank you. I think that's about all we've got. All right. Good
Thanks
deal.
everyone for joining.
Thanks, guys.
Thank you.
Thank you.